Hello, savvy investors, and welcome back to the Dividend Uncle channel. Today, we're revisiting a topic that sparked a lot of discussion previously, Suntec REIT. If you caught my earlier video, you'll remember my frank assessment that Suntec REIT is one REIT I will not touch with a 10-foot pole. Fast forward to now, and Suntec REIT's price hovers around 50% of its net asset value, or NAV, a discount that might seem tempting to any bargain hunter. But is this a golden opportunity or a value trap waiting to snare unwary investors? In our session today, we're diving deep into whether my past concerns, high gearing levels, sensitivity to interest rate increases, and a puzzling divestment strategy, still hold water, or if we're seeing a turnaround that justifies a second look. Before we unravel the mystery of Suntec REIT's current valuation, let's get the basics out of the way. If you value insights that help you navigate the complex world of investments with ease, make sure to hit that like button, subscribe, and turn on notifications for the Dividend Uncle. Your engagement helps me bring more content like this directly to you. Now, let's dive into whether Suntec REIT's current discount is an investor's jackpot or a cleverly disguised pitfall. Does FY 2023 results address previous concerns? 1. Gearing level and property valuations. One of our initial concerns was Suntec REIT's gearing level, which, according to the latest FY 2023 report, has seen only a marginal decrease from 42.4% to 42.3%. This negligible change does little to alleviate worries about the REIT's financial leverage. However, a large part of my concern previously was whether declines in the UK and Australian property valuations at end 2023 will result in Suntec REIT breaching the regulatory ceiling of 45%. This fear partially came true with declining valuations of its overseas properties, with UK assets devaluing by 10.2% and Australian properties by 4.5%. Thankfully for Suntec REIT, its Singapore properties, which account for 69% of Suntec REIT's assets, were sufficiently resilient, with valuations going up about 3%, resulting in the REIT's overall valuation rising 0.7%. For now, the gearing ratio, albeit high, should remain stable until the next revaluation at the end of 2024, alleviating some short-term concerns. 2. Interest rate sensitivity. Our analysis also highlighted the issue of Suntec REIT's sensitivity to interest rate fluctuations. The REIT's hedging position has deteriorated, with only 61% of its debt portfolio fixed or hedged, down from 66% a year ago. This decline in interest rate protection comes at a time when approximately $400 million in bank loans are due for renewal within the year. The average financing cost has surged from 2.94% to 3.84%, leading to a significant spike in financing costs from $20.1 million to $55.7 million. Management reported that a 10 basis points hike in average interest rates is expected to slash the DPU by 2.5%, and with interest rate cuts not anticipated until the second half of 2024, the timing and rates of loan renewals could exert considerable pressure on Suntec REIT's distributions. To provide the extent of the impact, an analyst estimated that the average financing cost for Suntec REIT may increase to around 4.2% by the end of 2024. This would represent a 35 basis points increase from the current rate, potentially causing the DPU to decline further by about 9% due to the increased interest expense alone. This forecast accentuates the pressing need for Suntec REIT to strategize effectively against the backdrop of a rising interest rate environment, emphasizing the critical importance of managing its interest rate exposure to safeguard its DPU and, by extension, unitholder value. 3. Asset divestment strategy. In 2023, a critical year where strategic divestments were necessary to mitigate high gearing levels, Suntec REIT's efforts to offload assets appeared minimal, with less than $100 million in divestments from its expansive portfolio, barely making a dent in its over $4 billion debt. More perplexingly, about $23 million of these divestment proceeds were distributed to unitholders as dividends. This decision to reward unitholders in the short term, despite the pressing need to alleviate gearing pressure, brings the management's strategic priorities into question. The minimal impact on the gearing ratio, a mere 0.1 percentage point reduction, underscores a concerning reluctance or inability to aggressively tackle financial leverage. This cautious approach to divestment, coupled with the choice to distribute a portion of the proceeds, necessitates a deeper inquiry into the management strategies for sustaining and enhancing long-term unitholder value. The Dividend Uncle's take. Suntec REIT's operational performance across its portfolio offers a glimmer of hope amidst the concerns. The consistent positive rental reversion and robust occupancy rates, especially in Singapore's office segment, are commendable. Suntec City Mall and Suntec Singapore's performance, surpassing pre-COVID levels, is particularly noteworthy. These operational strengths are significant plus points, reflecting a potential for steady operational income. However, despite these operational bright spots, caution remains the operative word. The near 20% drop in DPU is alarming and signals a trend that could persist into 2024. Although the valuation pressures on overseas properties may have abated until the end of next year, the focus now shifts to how Suntec REIT will navigate through the remaining months of 2024 to fortify its balance sheet. The management's ability to manage and mitigate the high gearing level, the proportion of fixed-rate debt, and the looming increase in financing costs will be critical. Based on their track record, I am not particularly optimistic that their balance sheet will be any stronger at the end of the year. In light of these factors, a cautious stance is warranted. While a 50% discount to NAV and a dividend yield of 6.4% may sound attractive, recall that higher interest rates are likely to decrease the dividend yield to about 5.8%. There are other REITs with stronger balance sheet and fundamentals with similar dividend yields, such as CapitaLand Integrated Commercial Trust and Fraser's Centrepoint Trust. Conclusion. As we circle back to Suntec REIT, now trading at half its NAV, it begs the question, bargain buy or value trap? Despite some operational strengths, the lingering concerns of high gearing, interest rate sensitivity, and strategic divestment decisions highlighted in my previous video remain pertinent. With DPU expected to face further pressure, caution is advised. Your thoughts on this are invaluable. Hit like, subscribe, and share your views below. Until next time, invest wisely and stay tuned for more updates.